guest, Mish Schneider. Mish is the chief strategist at MarketGauge, coming to us from beautiful Santa Fe, New Mexico. Mish, welcome back. How are you? How are you doing these days? Market overall holding up quite well.
It's incredible. We're actually a smidge from all-time highs in the S&P 500, which is so hard to believe, but still, we've got one of these disjointed markets. So I guess that's what we're going to talk about.
Yeah, it feels like a month ago that seemed like an unrealistic expectation, but here we are mid-May retesting that 5250 level. Let's get to some of the charts that you sent over ahead of time, Mish. We're starting with an interesting thematic play. I'm really excited for you to describe what you're seeing here. This is a stock, MP Materials, some may be less familiar with. What's the take here?
Well, this was a SPAC years ago when SPACs were really a thing. And it was a very high-performing SPAC. It actually is rare earth minerals, and it's the only place in the United States, which I believe is in California, where they're actually mining for rare earth minerals. And it had, from a SPAC to once it became publicly traded, had a phenomenal move up. And of course, it very, very much relates to EVs. And then it sold off, and it really hasn't done very much. But then with the announcement about the tariffs in China, particularly in EVs and in minerals, it kind of came back on my radar. And lo and behold, here it is exploding in one day today. It had a massive move up about 11%. So I want to keep it on the radar because it's not like it's too expensive. This was a stock that was trading much, much higher at one point. And now, if you look at the chart, you can see not only is it back over that 6-month calendar range low, which is the horizontal red line, it's above the 50-day moving average, and now today it cleared the 200-day moving average. Probably the perfect scenario would be an inside day or some digestion after this massive move. It could easily gap up, and you might want to run with that. I'm hoping sort of for more of a consolidation, in which case you have a really good risk to just about under today's low where that 6-month calendar range low is, and a lot of upside.
It's an interesting one. I love how you're combining the technical, the charts improving with more of the thematic story, right? What would cause a name like this to work, and using your MarketGauge proprietary indicators, strong momentum, strong leadership characteristics. Interesting name, and really recovering after a long-term downtrend. Your next chart, Charles Dow talked about looking at the Dow Industrials, the Dow Transports. Transports are an area that I've often heard you talk about. When you're looking at transports, what does that tell you about the configuration of this market here?
Well, this is exactly what I mean by disjointed. So in my economic modern family, there's obviously grandma retail, which, by the way, obviously has exploded the last couple of days, a lot to do with the meme stock. So we're not necessarily sure yet whether that means exactly that we know the retail investor is back, but we don't know necessarily if the retail consumer is back in a strong way. And then, of course, there's the small caps, which are also doing pretty good. All things considered, once Grandpa took out 200 on IWM, he's, up around 206, 207. I think 210 is the high. So this one, which would be the next major inside sector, as Druckenmiller once coined that phrase, and a key member of the family, is not doing what everybody else is doing. So it makes you wonder why. And there are two sides of the argument, and I don't want to stick to any particular argument. I want to be flexible, but I want people to keep this in their mind. So one is it really relevant? I mean, considering that we're a growth economy based a lot, obviously, on AI and chips, and this whole economy is basically moving more through computer technology as opposed to getting on a truck and moving. And that's certainly a valid argument. But there's also the other side of the argument that this is 6% of the GDP, and we still have most of that of the transportation is trucking, which still is the supreme way of how we get goods moved about in this country. And it's also a huge job creator as well, the transportation sector. So that makes me wonder, well, are we broken? Is this the stagnation? Is this the contraction of the economy? Or is this the early warning system, to a chart we're going to look at later, that was last year, in that things aren't quite as hunky-dory as what the market is doing right now? So you've really got to keep your eyes here. We have a bearish divergence in the momentum because it's under the 200, where here it's above the 200. It is above the 6-month calendar range high, which is that green horizontal line. So it's not horrible, but it closed red in a day when we had a lot of green. So just keep it in your minds. That's kind of what I'm here to say.
Yeah, no, that's a key one. And groups that are down on a decent update for stocks, always worth paying attention to for sure. Gold having another strong update today. Gold and precious metals obviously have done quite well. The GDX, the miners, starting to improve. Do you think there's more to be had on the upside here?
Absolutely. And the reason why I brought this one in is because clearly I have been on the commodities page for a long, long time. And what's been so comforting as a former commodities trader on the floor, but now as an equities and commodities trader, is that it has really given me patience because the gold and the silver and now the GDX, which we've been in for a while, and some of the other metals as well, have done so great. And they're in such a good trend that you can really kind of step back and decide what equity you want to buy, which is why I'm showing transportation and why I showed MP materials, which might be more commodity based. But getting back to the miners right here, I mean, you could see that we're sort of looking maybe a little bit like a new bottoming pattern has formed with that sort of sloppy head and shoulders or inverted head and shoulders bottom. And the neckline really needs to break out here, I would say, over like that 35.50 to 36.
Mm-hmm.
But it's leading the gold, and silver, by the way, is outperforming the gold. So these are two key inflationary indicators. So, you know, the whole stagflation, which Powell poo-pooed the other day, this is proof about the inflation part. And besides, obviously, the PPI coming in hotter. And the transportation might be proof of the stagnation part. And that's why I wanted to show how that all works out. A, it's scary for the Fed, but B, it's really good opportunity for traders if they find the opportunities in the things that will go up, like the gold miners.
It's interesting with a chart like this, if we could stay on this for a second. I mean, this is a chart that appears to me to have a really just a strong setup as you described, right? We're breaking to a new swing high, really close to sort of breaking out of this consolidation. Looks like strong momentum, a strong relative performance. What would you see on a chart like this that would tell you things are changing? What would be like your way of managing downside risk on this? Is it something as simple as like a break of support, break of the 50-day? Is it some of the indicators at the bottom rotating in some particular configuration? Like what would you be looking for here?
Well, number one is I would look at real motion. And
Yeah.
that's the bottom chart. I mean, we haven't gotten through the Bollinger Band yet, which could mean A, it's running out of steam. You know, one thing we know as traders, right? You have to be so open-minded and flexible. I mean, there'll be times where I'll be 100% sure, and I am certainly not shy about saying that when I am. But I also have learned how things can humble you very quickly. So I will look for the fact that the momentum hasn't gotten through the Bollinger Band. Is this just consolidation like we're seeing in the price? Or does this mean it's going to start to roll over? And if it breaks down under the 50 in the real motion, even if it hasn't quite got there in the price, which is that blue line on the price, the 50-day, that would probably make me at least take some profits and tighten up stops. Or if the momentum doesn't do much, then I would look to see if it starts underperforming the SPY. Now, the SPY is doing pretty darn well, right? We just said it's near all-time highs, but this is still outperforming. So if it starts to underperforming, maybe the whole commodity narrative starts to shift. Questions in mind. And number three, of course, would be just an out-and-out break of the 50-day moving average. So, or some kind of a explosive move up with a massive reversal. All these things would be in my mind. But right now, I think it just says stay the course. This is consolidation. And when you have days like today where there's a lot of money going into equities and meme stocks, of course, GDX is not going to be a great outperformer, but it did actually close green. Good sign.
And for now, the chart certainly seems to be constructive. It's well described. I appreciate that. Your last chart, regional banks, this is a monthly chart. All the other charts you'll be looking at have been daily charts. This is a monthly look at the regional bank ETF. Talk us through this one and what you're seeing here.
Well, I really love monthly charts, and you and I have done monthly charts before because it represents two real business cycles, the 23-month, which is 1 month shy of a 2-year business cycle, but it's a good heads up that we're going either from a contraction into an expansion or in an expansion and we're just continuing or et cetera. And the 80-month, which is the green one, which is really more of a 6 to 7 year business cycle. And we know business cycles tend to run in 6 to 7 years, but you do have these sort of mini business cycles of 2 years in between, and that's well documented. So yesterday, actually, in my daily, I wrote about Alibaba because it was amazing. It went right up to the 23-month moving average. And of course, earnings came out and it retreated from there. This I'm looking at for the opposite reason. So as I mentioned about transportation, sometimes you get members of the family that just kind of go rogue and they tell you something's going to happen, even if it doesn't happen right away. And certainly this is what was the case last year. Look at that nasty red bar in March of 2023, when everybody was so bullish in the market. It's just going to continue to go up, 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 up. The Fed is going to, cut rates, all of the stuff we always hear for the reasons for the market to go up. And I'm watching KRE saying, not so fast. And of course, then the whole banking debacle came out and we had a nice close to 20% correction in the market. Didn't last, but still. But since then, this hasn't done very much. And it's been under that 23-month really since the peak in the market in 2022. So now here we are in a range pretty much still between 45 and 50-ish, but that 23-month is coming into play. So what that tells me is either that's going to be major resistance and it's going to support the fact that transportation is right, telling us that things aren't so great and everything else that's been running needs to get some reality, or it could be telling us that this whole commercial real estate sector, which is really what regional banks are all about, which is why they suffered so, is starting to turn around, and that could be because you want to call it soft landing or you want to call it a twist, Operation Twist, where the Fed tries to flatten the yield curve, or things are just improving, and even commercial real estate is going to start to improve, even if that means it's changing how it looks. So that's why I'm fascinated by this. So if this thing closes this month out, May, over that 23-month, which is around 3130, so excuse me, 5130.
Yep.
It's not quite there yet. I would certainly, I mean, it still has the 80-month to contend with, but to me, this 23-month right now may even be more important.
This is so helpful. I can't thank you enough, Mish. Some really interesting thoughts about how the technicals fit into all the other things we're thinking about, particularly regional banks, thinking about how that relates to what the Fed is going to attempt to do here in 2024. A lot to think about, and thanks so much, as always. Be well, and we'll talk to you again soon, Mish.
Thank you so much, Dave. It's such a pleasure to see you.
That's Mish Schneider. Mish is the chief strategist at MarketGauge. These comments were fantastic. I feel like every one of those charts, some really thoughtful observations on there, particularly that last one. I was talking with Mish before we got started today. You're talking about how regional banks really do well when the yield curve is more normalized, and talked about improvement in regional banks may be part of a different theme, more of an evolution where the Fed starts to maybe create a more normal shaped yield curve. We've had that inverted yield curve for so long. A more normal shaped yield curve means regional banks have a much more of a tailwind for future gains there. Great charts there, and appreciate the multiple time frame analysis from the great Mish Schneider at MarketGauge.